I've always wondered myself, why do we have to hear this every night, what the stock market is doing?
70 record closing highs so
Today, we're tackling a subject that's undoubtedly on the minds of many parents and students out there: how to save for college without putting your money into the unpredictable world of stocks. According to our recently conducted college savings survey, a significant 68% of respondents have already taken the step of saving for college using various types of accounts. Interestingly, among the 32% who haven't started, a substantial 44% cite the lack of time to research their options as the primary reason. So, let's dive in. 1. 529 Plan. Let's kick things off with the well-known 529 Plan. This education savings account has gained popularity due to its enticing blend of federal and state tax benefits, granted that the funds are used for qualified education expenses. One of the biggest perks of a 529 plan is that both the earnings and withdrawals are entirely tax-free when utilized for college expenses. Withdrawals spent on qualified higher education expenses and up to $10,000 per year in K-12 tuition can avoid federal income and capital gains taxes. Depending on the chosen plan, maximum investments can surpass $500,000 over the account's lifespan. Moreover, contributions of up to $17,000 per year per individual qualify for the annual gift tax exclusion. An intriguing option allows you to treat a contribution of up to $85,000 in 1 year as if it were spread over 5 years to shield a larger amount from taxes. A notable advantage is that 529 plans receive favorable financial aid treatment. If the account is owned by a dependent student, it is treated as a parent's asset, and withdrawals for college expenses don't need to be reported on the FAFSA. Starting in 2024, unused funds in a 529 plan can be rolled over to a Roth IRA tax-free under certain circumstances. However, it's important to note that earnings are subject to income tax and a 10% penalty if withdrawn and not used for qualified education expenses. Investment options are limited to what's offered by the program, restricting your choices. 2. Mutual funds. Moving on, let's talk about mutual funds. These diversified investments, managed by financial advisors or bank specialists, offer the chance to invest your money in a variety of securities, including stocks and bonds. What's attractive about mutual funds is the flexibility they offer in terms of spending. The funds saved in a mutual fund can be used for various expenses like purchasing a car, airline tickets, or computers. Furthermore, there's no imposed limit on how much you can invest. With more than 10,000 mutual funds available, you have a wide array of investment options. However, it's important to remember that earnings from mutual funds are subject to annual income taxes. In addition, any capital gains are taxed at the time of selling the shares. Parents, take note. Mutual fund assets can impact your eligibility for financial aid, as the FAFSA considers money transferred from mutual funds for college expenses as income. 3. Custodial accounts, UGMA, UTMA. Custodial accounts under UGMA, UTMA offer a flexible approach to saving for a minor's future, including college expenses. Established by adults on behalf of minors, these brokerage accounts provide diverse investment opportunities encompassing stocks, bonds, and mutual funds. This versatility allows for potential growth, while the adult custodian maintains control over the investments and decision-making. The major advantage lies in the flexibility to use the funds for various expenses benefiting the minor, extending beyond college costs to cover needs like purchasing a car or funding extracurricular activities. However, considerations include the kiddie tax on earnings, the minor gaining control over the account upon reaching legal adulthood, potentially differing from the custodian's intentions, and the impact of the account on financial aid eligibility, as it's categorized as a student asset on the FAFSA. In summary, custodial accounts under UGMA, UTMA facilitate a versatile savings approach for minors' financial needs, inclusive of college. While they grant control, investment diversity, and adaptability, they also warrant careful tax management, long-term planning, and an awareness of potential financial aid implications. What's great about custodial accounts is the flexibility they offer in spending the saved money on various expenses, as long as they benefit the minor. Furthermore, there's no set limit on how much you can invest. However, it's important to be aware of the kiddie tax, which applies to earnings and gains and is taxed to the minor. Additionally, when the minor reaches legal age, they gain control over the account, potentially using the money in ways different from the parent's original intentions. It's worth noting that custodial accounts are counted as student assets on the FAFSA, which can reduce a student's aid package. 4. Qualified U.S. savings bonds. Let's now turn our attention to qualified U.S. savings bonds. These government-issued debt securities are considered a low-risk investment due to their backing by the U.S. Department of Treasury. The advantage of U.S. savings bonds lies in their federal tax-deferred status and state tax-free nature. Particularly, Series EE and I bonds purchased after 1989 can be redeemed federally tax-free for qualifying higher education expenses, making them an appealing option for saving for college. Investors can take comfort in the fact that they're investing in interest-earning bonds backed by the full faith and credit of the U.S. government. However, it's important to remember that there's a maximum annual investment limit set at $10,000, $20,000 for married couples, per owner, per type of bond. Additionally, the interest exclusion begins to phase out for incomes within specific ranges, which varies based on filing status. If bond proceeds are not used for tuition and fees, interest earned will be included in federal income and subject to taxation. 5. Roth IRA. Let's now explore the Roth IRA, a retirement account that offers after-tax income contributions and tax-free interest accumulation. One of the key benefits is the ability to withdraw contributions at any time, for any reason. Furthermore, if you spend the funds on qualified higher education expenses, the normal 10% early withdrawal penalty on earnings is waived. Another advantage is the wide range of investment options available within a Roth IRA. Worth noting is that retirement account values are not considered assets on the FAFSA. However, it's important to be aware of the maximum investment limits. In 2023, the cap is set at $6,500, $7,500 for those 50 and over. Additionally, only individuals earning less than specific income thresholds are eligible to contribute the maximum amount. Married couples with higher incomes may be ineligible to contribute, and withdrawals for college expenses are considered base year income on the FAFSA. 6. Coverdell ESA. Lastly, let's dive into the Coverdell Education Savings Account, ESA, formerly known as the Education IRA. Similar to the 529 plan, Coverdell ESAs allow tax-free interest earnings and withdrawals for qualified educational expenses, including K-12 expenses, up to $10,000 per year. These accounts offer a broad range of investment options, and you can even self-direct your investments. An interesting aspect is that the value of a Coverdell ESA account is counted as a parent asset on the FAFSA, regardless of ownership. Nevertheless, it's important to know that there's a lower maximum annual contribution limit, set at $2,000 per beneficiary from all sources. Contributions must also be made before the beneficiary turns 18, and the account can only be utilized until they reach 30 years of age. Additionally, only individuals earning less than specific income thresholds are eligible to contribute. How to decide which plan to choose? With so many college savings options, choosing the right account for your child's education can be challenging. Here are some questions to consider. If you plan to use the funds solely for college expenses, a 529 plan offers substantial tax benefits. If you need flexibility in using the funds for other expenses outside of college, custodial accounts and taxable investment accounts provide more leeway. If you're relying on federal financial aid, be cautious about which accounts you withdraw funds from, as certain accounts can affect aid eligibility. Consider the amount you plan to save. Different accounts have varying contribution and income limitations that may impact your ability to save. Tips to complement your college savings. If you need more money for college, there are several ways you can consider. Apply for scholarships, even smaller ones can help. Grants are like free money for school, so look into those. Working part-time in the summer can give you extra cash for college. You might also earn college credit while in high school through advanced placement, AP courses, or dual enrollment. Remember, loans should be your last choice if you can't get enough money from other sources. There isn't a one-size-fits-all approach to saving for college, but the key takeaway is to start early. Whether you opt for accounts with tax benefits or flexible spending options, taking steps to save for college now can greatly alleviate the financial burden later on. Thank you for joining us today as we explored the world of college savings without venturing into stocks. Remember, the best approach is one that aligns with your financial situation and goals. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more informative content. Until next time, take care and happy saving.